Today, my guest is Vinney Chopra. Vinney's an accomplished multifamily syndicator, and we're going to get into some multifamily talk with Vinney. But first, a quick reminder, if you like the show, please let us know. You can do this by liking, you can leave a comment, you can share the show, and don't forget to subscribe. And also, if you'd like, be sure to check out our YouTube channel if you would like to see the guests and see the conversation. We have that as well. You can find us at Commercial Real Estate Pro Network. All right, now we're ready to talk with our guest, Vinney Chopra. Vinney, welcome back to CREPN Radio.
Thank you, Darren. It's a pleasure. It's really a pleasure. Boy, I was listening to myself talk this morning. I wanted to see what did I talk about, and it was about 6 months back. So.
Oh, right. No, exactly. And returning, if you would like to hear the first episode that Vinney was on CREPN Radio, you can look on, and I'll put it in the show notes, but it was number 118, where we got into kind of a multi-topic discussion about multifamily. And that went really well. And Vinney and I have talked over the last couple of months about trying to do some more. And so we agreed, and we're excited to start kind of going through multifamily in more detail.
Yes.
And but before we do that, Vinney, if you could just kind of refresh for any of the guests that aren't familiar with you, if they're not, just give us a little bit of your background and how you got into multifamily.
Oh, sure. Darren, I'm from India originally. I came to this country land of opportunity about 40 years back. I'm a mechanical engineer from India and landed into Washington, D.C. area with $7 in my pocket. That's all I could bring. And I had engineering. I wanted to do MBA, Master's in Business Administration in Marketing. I always thought combining the two will make me more successful and so forth. And that's what my main thinking was. It just so happened that when I came here, I had to earn tuition to pay for my college and university like that. One of my friends said, "Hey, what are you doing for summer?" I said, "Nothing, I don't know. I had just come back and nobody could understand me." A lot of people can't understand me still. But then I sold books and Bible books and encyclopedias around Atlanta and Pulaski, Virginia, and Aiken, South Carolina, and rest is history. I just love to be out there, and talk with hands, not on a pencil or pen, and you just be very outgoing personality. I thought, okay, let me try, and I became a consultant, marketing consultant, promotional consultant, and giving speeches. I've given over 10,000 speeches and all that, and I stayed with one company for a long, long time. Great people, great. And it just kind of made me also develop my skills in sales and presentation and all that. And then we were purchasing single family homes, by the way, for 30 years. We've been married 38 years and we live in the Bay Area now with the Bay Bridge in the background in my studio.
Beautiful.
Thank you. Thank you so much. And, and we really love real estate. My wife and I, she was also a real estate agent for a couple of years. And she said, "Vinney, you should go for a broker license." At that time, you could do it. You just go and learn the material. And I got a lot of exemptions because of my engineering and the marketing background. And I went there and crushed it. I passed the broker exam within 3 months, I think, and rest is history. Then after that, we were still buying, by the way, single family homes, as many we could save money. Let's buy some. And I think I talked about one in my last meeting with you, which we bought for $61,500 with 11,000 down, I remember, and it went to 325,000, and we refinanced that. And we just sold it, by the way. I just want to let you know, every single home we bought in last 30 years, we sold them all in 2017.
They're all gone, huh?
They're all gone. And we are concentrating on multifamily. I'm so bullish, so excited, so charged up at this tender age, young age of 65. I'll be 66 coming up here in August,
I love it.
Thank you, Darren. And I really believe in life to have passion, compassion, and enthusiasm to make it happen, because I have a goal now, my vision board, you can make digital vision boards now, right? Previously, I
Uh-huh.
used to make with picture cutting and everything on the board in my office. And it's so important that we have the next 5, 10, 15, 20 years in writing what we want to become, who we are right now, and what we want to change and grow and develop into as a person, as a personality. And like I said, I believe in 30, 30, 30. Instead of 4 quarters of, our game and, football or any other game, I believe in three segments, 30, 30, 30. So 30, we kind of take education, we settle down, we get married. Next 30 up to 60, we really excel in our business, our professions. And then next final 30, we want to leave a significance and also really make a big impact on the world before we heavenly go up there,
No, that's I like that, the 30 30 30. That's great. Well, let's talk a little bit here, because what you and I would like to go through is multiple topics related to multifamily.
Yes.
And I think probably a great segue from what you were talking about your single families is to just ask the question, why are you going, or why have you left single family and you're bullish on multifamily?
Fabulous, fabulous. Right about 2004 or so, when I got my broker license, the job was, and I was a promotional consultant too, by the way. I had a big organization with my other company. But the irony of the situation was that we were able to go give speeches in about 5 months in a year, and 7 months were very easygoing kind of thing, And I believe in multiplying myself. I had a staff of people who could really do the legwork, and then I get on the stage, when I needed to be and things like that. And that's when I said, oh my gosh, I got to do something more positive and more exciting in real estate. And I started looking into commercial. I said, residential, we have had homes, and sometimes we made cash flows, sometimes we didn't. If the boiler went out, there goes the cash flow. If
Yep.
the resident left, tenant, we never say tenant anymore in our new philosophy. They are the residents, they are bona fide residents in our communities. And, so if they left, it's 100% vacant. And now you have to give the leasing money to the management company. We never managed ourselves, by the way. All our properties were scattered down in Los Angeles, Bakersfield, inland, Georgia. Then we had, Arizona, all over the place,
Right.
Odessa, here, there, all over. So we said, oh my gosh, there goes the cash flow. So it was not a consistent money coming in. And also it was a lot more effort because a lot of management companies were gouging. I mean, they are still gouged. So I started finding the contractors myself in Arizona, in the different 3 properties we own over there, and have them on my iPhone, so that when the property management company told me that this resident needs something, tenant needs something, I got my handyman, my people to go there.
Right.
I just want
Right.
to pay that 30% surcharge, really,
Yeah, no, exactly. Get control of the cost, right? Keep your costs.
Totally, totally. So that's when I looked into, of course, single family, we already were doing it. I looked into hospitality, the hotels, looked into the office space quite a bit. Actually, I even talked to CBRE and Sperry and had some interviews with them to see how they pay. See, if you lease the space, office space with a tenant for 5 years, you get your commissions up front, because the seller or the owner has to pay the commission up front. And then it's a triple net lease or things like that. So I liked that idea. I said, oh my, okay, I can make 100,000 a pop here or 80,000 over here, which kind of attracted me. I'm always being a big thinker. I
Right.
mean,
Right.
it's good to think big. If you think small, you stay in the small numbers. If you think big, you can really excel, and you can really get your mind, your subconscious and your conscious mind to really work with you to reach those big heights. And that's what, I find it's so true. We got to really do the victory in our mind before we do show the victory out there in the world. So it's
Yeah.
so important to really get ourselves psyched up with listening to great podcasts like yours and others, motivational books. I mean, I credit who I am today to Jim Rohn and the Zig Ziglars, Tom Hopkins and, Tony Robbins. And I mean, I can go J.W. Schwartz and Napoleon Hill and all these great people and Robert Kiyosaki, all those people.
Yeah, no Debbie Downers in that group, huh? That's good.
That's right. And then also it's the company you keep. You are the sum total of 5 people who you are interacting with. We have listened to it, we have heard about it, but some people just don't look at that and say, hey, that guy in my circle should not be in the circle because it's too negative. He's
Yeah.
always questioning everything. He's putting me down.
Right. Right.
Those kind of things.
No, so you win in your head first. I mean, that's kind of like
exactly.
Right?
We got to conquer the stinking thinking, right? That's
Right.
what I think Zig Ziglar used to say. I was just talking to one of my students, and we talked about the hand pump. The hand pump that he carried it with him in the airplane, and he had at 76 so much energy, more than any other presenter on the stage. And he would talk about how you have to put water into the hand pump. Like in India, we have a lot of hand pumps, right?
Yes. To prime the pump there. Prime the pump.
Exactly.
Right? Yeah.
You have to put the energy and the water in, but you keep on pumping. Then the big outflow of water starts coming in,
No,
and the same thing is true in life. But let's talk about what I came to know looking at industrial, office space, hospitality, strip shopping centers, retail centers, all that. Multifamily. When I started researching multifamily, everything I researched on Google, this is 2004 now, 2004, 5, almost 14 years back now, right?
Mm-hmm.
It just caught me attention. I said, oh my gosh, this is amazing. I mean, I can have all my 20 homes in one space. I'll have to take care of only 2 roofs, and I have to take care of only 1 boiler, then 20 boilers out there. I don't have to deal with so many handyman and all these people and property management companies all around the USA, and that really made sense to me, really, Darren. I said, my gosh, I did 20 transactions to get these homes, and I have to qualify for every single one.
Right.
If I buy all 20 in one place, I have 1 transaction, I have 1 broker to deal with, I have 1 loan. It just made sense. And being a mechanical engineer, logic makes sense to me.
It all added up, huh?
It all added up very quickly in my mind. And then I started looking into, hey, where is the economy going? I started to look at the more and more I found out about multifamily, by the way. At that time, when I did some research and bought some books and all, it said about emerging market. That was the thing really caught my logical mind. Okay, Vinney, you got to go after emerging market. You got to go where there are more people who have good jobs, unemployment is low, and also where jobs are there and where the growth of job will happen.
Right.
See, that's where the emerging market is right now. I teach that in a very big, lucid way, because if we don't find a gold nugget, a good property in a good market, as a syndicator, the world I've lived in the last 12, 14 years, I'll be dead. I'll be dead.
Yeah. You don't want to go out to the desert and buy a property out there and nobody shows up, right?
Exactly. See, if you buy a property in a place, unless I can sell that property and its surroundings and its numbers to a group of investors who will bring the money at closing table, then I'm not a syndicator. So syndicator has 2 jobs. One is to find the money with the investors. The other one is to find the great deal and put them together. That's
Right.
it.
No,
Just by
exactly.
doing it, that's syndication.
That's it.
And that's what excites me. Yeah.
Well, let's back up here just a second, because you touched on the market, which I think there's great power in the market, and I think that what I'd like to do is kind of hold that for a future conversation to get into the details
Totally.
of the market, but just to focus on multifamily as the case for multifamily.
Yes.
And I think you started going down there about the one roof versus multiple roofs, the one boiler. So what would you call that? The sum of that, is that basically just
It's
a
called economies of scale.
okay?
If the word we talk about is economies of scale, where you can scale it up in a multifamily much better way than an economies of maintenance and economies of having a maintenance person or a management company person, you can do savings. We call them as savings of maintaining apartment buildings or houses through economies of scale. When you have to buy 10 doors or 15 doors or windows or glass, or you could have a lawn mowing company to
Right,
do it for one place rather than 20 different yards.
right,
So
right,
economies of scale is a very big thing in multifamily that we can do. Having one loan is a big advantage also in the multifamily, so we could dig into that one. Single family, oh my gosh, you can have as many as 10 homes, or I don't know what the new laws are, so many loans, and you have to qualify every single time to on your credit, on your FICO score, on your potential, of the investment and the down payment. You have to qualify every single time for single family. In multifamily, it's very different. They do look at you as a operator or as a person who will be the managing member of the LLC. So we never purchase a multifamily under Vinney Chopra name. Never.
right, right.
We
So now you're jumping into the financing thing, just as the difference between the two.
correct.
And why don't we just kind of complete that thought here? So the difference you were saying is that, and what I think you were going is when you're buying a single family property under Vinney, the bank's
Yes.
looking at Vinney, whereas
Yes.
if you're buying it in the LLC or the multifamily, more of an income property, they're looking
Correct.
at the property. Is that right?
Totally, totally. They're looking at both, but
Okay.
they are mostly looking at the NOI, the net operating income. That's total. We'll do a whole session on all that. But as the total rents collected, total income, total everything, RUB system minus the expenses, the NOI, net operating income, that's what the banks like to see. And then how much it is, what's the DCR ratio, that's the debt coverage ratio, because they want to give you the mortgage on that property. That apartment building could be fourplex is an apartment. It's a multifamily. Anything more than two unit is a duplex, then triplex, then fourplex. I really promote to go for 8 and 12 and 20 and 70 units, because the difference in getting that 8 units and the 70 units is just the money
Right.
and the
Right.
experience a little bit. But I teach everything. How can you crush it? Getting the partners, getting the, all that stuff. But let's talk about the qualification, I call it, right? So qualification is much easier in the multifamily, and you can scale it up. You can scale it up like I have gotten over $200 million. A $7 guy can control so much and be on the loans of all these 26 properties,
Wow.
amounting to that number. So it's scalable. It's scalable. And the good part is that they look at the property more along with the FICO score and my strength and liquidity and all that. I don't want to just misnomer and say you can do it right away. But you're right. The getting loan is easier. The other part also is that, loan to like single family, maybe we can get 70% loan. I've never bought a single family for a long time. Now, I don't know, but maybe 70 or 65% loan. But in multifamily, if the numbers are correct, Fannie Mae, Freddie Mac, and local institutions and insurance companies, they are able to come 80% of the money.
Right. No, and that's huge. 80% loan to value. Now
Yeah,
that's the whole beauty of the other people's money, right? Now
it's
you're
amazing. It's
yeah.
totally amazing, Darren. I mean, I have bought properties where I had to pay only 18% because the property value came higher. In the docs, they said 2080 and the 80% of the appraised value. Appraised value comes extra high, then you even go lower in the down payment.
Gotcha. I want to ask you about, you mentioned net operating income, and I think what's important, just again to make the case for multifamily, is talk a little bit about the control you have over the net operating income and essentially the value of your property, and compare that to the single family marketplace. Can you do that?
Love to,
Okay.
Darren. That's exciting. That whole thing, what you're mentioning about. See, single family, again, you are managing it, or even if you get a management company, if it's too far away, they're going to charge you 7 to 10%, something like that, to manage your home, to collect the rents. They will also charge the commissions, of course, to lease it up if the vacancy comes, and if they're doing the upkeep and all that. Your rental home is not going to be worth a lot more than similar kind of properties around in the neighborhood.
Right.
Next door, 2 bedroom, 3 bedroom in that same vicinity or like that, it's going to not appreciate unless the whole neighborhood appreciates quite a lot. Your rental home, your property is not going to drastically increase in value. As compared to multifamily, what I really love is that we are able to bring value into for the residents, like as we take over in my case, and anybody else who's also managing the multifamily, they know it. As soon as we sign up the contract, we take the keys, we are bringing new attitude, new ownership, new regulations, new thrust of enthusiasm, new money we are putting into the asset with the media centers, with the the residence centers, we call it, cafes, dog parks, and maybe even the basketball courts and the barbecue pits, different things like that, benches, playground equipments, all those great things add value to the multifamily. Now we can then ask them to increase the rent, because as we look at the rent roll, we are always comparing how is this seller who is selling the multifamily, what was the bad things they were not taking care of? Was the management on top? Were they 100% occupied? If they were 98 to 100% occupied for 1 year, there is some fallacy. They are the lowest rents in the neighborhood.
Right. Right.
So we look at all those value plays, I call it. These are the value plays that we start doing one by one, one by one, one by one, and then we add value to the residents, and that increases the rents, and we decrease our expenses also by taking over our communities and really regulating the administrative expense, insurance expense. I would love to talk about how to do master plan insurance. It's amazing. The world is amazing out there, how we can save every single line item in the underwriting tool we talk about, and also the payroll and the marketing and the contract services and all that. But let's talk about adding value. RUB system, that's a big one. That's the ratio utilities bill back system, right? RUB system, that's a huge one. Lots of your audience knows about it, I'm sure. And as soon as we get into it, we find out what's the maximum in that state we can charge the residents to live in the apartment building that you are managing. Now, electricity is usually individually metered. So the resident pays that, but the water flow, the big pipe, brings the whole water into the whole community. And as an owner, we get master billed.
Right.
So when we get master billed, we can take 86% of that actually, total cost, and divide that into the residence for 1 bedroom studios or 2 or 3 bedroom. We call it flat rate. I like it flat better than all these numbers
Right.
changing every month. There
Right.
are third party companies. They take your master bill and then they ratio it out, send the invoices to the residents and so forth. I don't believe in that. I like the flat one. And then trash and the pest control and sewer. So all those 4 things we are able to bill back. So that adds value. So answer your question now, as compared to single family where you have no control almost to increase the value of that house, in the multifamily you have full control right here to increase the incomes, decrease the expenses, increase the NOI, and be sure that you are doing everything possible to make sure all these different jobs in the emerging markets where these new jobs are coming, we are promoting it. And I would love to do a whole session on my whole marketing techniques, what we are doing now, because we not only buy the properties in Monil Investment Group, we manage them ourselves for the last 11 years. All these things in 4 companies that I formed. The 2 new ones we manage, even the old one too, we manage our own assets. So that
Right.
way we can bring value to the residents. And it's
Yeah.
just very exciting. Yeah.
So just to be clear here, so the ability in the multifamily, you can drive the income up if you find that you're under rented.
Yep.
You can decrease your cost if you find some operational things that the prior owner or management was not doing,
Totally.
thereby increasing the net operating income.
Right.
And that again then drives the value based on the market cap rate, right?
Correct. Market cap rate is the big thing, which again, it depends how we are. If we are buying in emerging markets, if more jobs are coming in, if there is more demand for rental, households, then the cap rate, because a lot more euphoria goes into that. And as the area improves, the cap rate goes down,
Right.
as we know. And that's what happens also. We, in our projections, don't like to decrease that at all. Actually, we keep it same or even add it, just
Right.
so that we are very conservative, in that format. But you're right. It's the NOI, the cap rate that really brings the value, much higher level.
Compare that to, again, like we said, the single family, you're just stuck with whatever the neighborhood's going for,
Exactly.
right? Okay.
Totally. Totally.
Let's talk a little bit about some of the other aspects of multifamily, and I guess
Yeah, let's talk
you
about
talked about,
taxation.
what's that?
Taxation.
Yeah, I was going
Tax.
to say, let's do it.
Okay,
So,
perfect. It's really wonderful and our investors love it. These are doctors, attorneys, and individual owners and all who have really gone from 0 to 130 in my case, and they love it because they are making ton of money. But then when they get these distribution checks, several thousands of dollars, when the K1 comes, Darren, K1 from the property LLC, which I'd like to explain right now, they love it because it shows the property didn't make money. Even though the property made money, lots of money,
right,
300,000 maybe the property was making money, but on their K1, it shows it went in loss.
right,
And
right,
that's the paper loss due to depreciation. So
right,
the depreciation is one factor in multifamily, which is amazing. And now all of us do accelerated depreciation. So what that means is we could take the total structure, whatever we purchase price minus the land, and then because land doesn't depreciate, then we take that amount and divide it by 27.5 years, 27.5, that comes with a number of the property that we can depreciate. The laws say that after 27.5 years, this structure will be worth 0. It's
right,
not going to be worth anything at all after 27.5. Now, in cost segregation, or accelerated depreciation, we call it, same thing. We get a company, CPA company, which is very established, and they come into your community, into each floor plan. They figure out what are the knobs costing, what are the kitchen cabinets and the circuit breaker, how far the circuit breaker is from the all the lighting, the switches, all those different things. They do the whole study. Then they find these components can be depreciated over 5 years.
Right.
These totals can be depreciated over 15 years. And then the rest can be depreciated over 27.5 years.
Right.
So that way, that extra depreciation in the first 5 years helps a lot to bring negative, and all the entities, and I hope all your audience, they purchase properties, single family or double family, multifamily, in LLC structure. I like LLCs better than land trusts and everything. There are great LLCs, Wyoming, Mississippi. They behave just like Las Vegas and also Delaware. They have the same requisites, same everything. Very simply, I love Wyoming LLCs. And if they form those, it's very easy structure. They're pass-through entities, we call them, right?
Right.
So they do not pay taxes. The LLCs don't pay taxes, but from the income coming in and expenses going out and distributions going out and everything and all that, every single member of that LLC gets to get the benefit of it. So
Right.
the investors get the benefit of it, and the general partners like me, GP side and LP side, limited partner and general partner side, they all get. So taxation wise, the tax ramifications are great, in multifamily.
All right. So that's, you've touched on the cash flow aspect of the taxation benefit, right?
Yep.
What else? What other options are there for
Surely.
tax
See, because
benefit?
all our investors are equity partners. So we give them a preferred rate of 8 to 10% per year. They get paid first in all my syndications, right? But then at the equity end, which is the gain in the value, when we sell the asset, it's a capital gain, long-term capital gain, which also is divided between the investors and us, right? As the
Okay.
GP partners, 65-35 or 60-40 or 70-30, depends, right? How good the deal is. Market is kind of tight right now, as 2018, product is not out there. So we as syndicators have to be more creative, find better listings that pocket listing, I call it napkin listing in my new book coming up. Napkin listing is the word where these brokers don't even have the listing yet. The ink is not even dried, but they just took a little address on a napkin and they shoot it out to me or to other people in the list, and then we do the research and all that. But the key thing is that all these, when we sell the property, there is a big gap, right? Like I think I might have mentioned in the last interview, we had 3.550. We purchased a property. There were 16 burnt units. We built them back up. 1.3 million, I think we put it into it. And now we are selling for 8.750. So that's a huge, huge capital gain. My investors are going to get the brunt of it because it's going to be passed down to them, but it's not a ordinary income gain. It's a capital gain because of after 1 year, it becomes long term. And with Trump in the office and, reducing this taxation and all that different rules, who knows, maybe in next few years, we might be paying only 10% capital gain. We don't know, right?
Right.
But that's what that equity gain will come back. But then depreciation, whatever we took, it has to be recaptured back on sale. I do want to mention that, right?
Right.
But all these people, they love it because when they get the cash flow, they are making ordinary income. So they might be in a 50% bracket, 40% plus the state tax, like in California, 13.4, high one, the highest probably in the USA, you end up paying 53% or whatever for the income. They love that being negative, and then they won't mind paying the capital gain, when we sell.
Right. At a reduced tax rate at the capital gain.
Correct. Correct.
Right.
Yes.
So
Yes.
let me ask you, can you speak at all? So, and I don't want to get bogged down in it, but just there are ways to defer the
Yes.
tax on sale. You want to get into that a little bit?
Yes. I'm so glad you're asking me.
All right.
I had several interviews with CPAs and attorneys in the last, because we are selling so many things. And of course, 1031 is the term, which is if we sell a property, we can take the the extra money after we pay everybody, the gain, which we call it, into another like-kind property. So the rental property has to be bought into a rental property. They could be into a business, actually. That's what it is. Primary residence who can only transfer into primary residence, things like that. Is that right? Wait a minute.
I don't know,
I'm
but
trying to.
I think just on more of the investment properties, but if we just stay,
Investment properties, exactly.
with the real estate, and I think that what I understand basically is simply is you have to have your intentions had to have been investment.
Correct.
And if you take whatever that gain is and you roll it into a next property that's as much or more than
Yes.
the property you sold, you can defer the tax to the next sale.
Totally.
Correct?
To the next sale, and we could keep that and grow that money in that property few more years, and then that total gain, which was from this one, second one, into third one, and fourth and fifth. And as I see the law, maybe I'm wrong, that it dies away. If you die and pass it to your heirs in your estate, then you don't have to pay taxes. Is that how you also?
No, I think I'm not a CPA, but I do believe that is correct, in that your heirs would get the stepped up basis. So
stepped up basis, exactly.
whatever the value is upon your death, and they would inherit that, and
yes,
no tax due.
No tax state. That's what I understand, Darren. The other one I would love to share with your audience, it's called swap and drop. Swap and drop. What that is, it's a new term, but not too many attorneys, but quite a few attorneys and CPAs have done that, where what you do is, as you're selling the multifamily, as I'm told, I'm not a CPA, by the way, I want to make sure. I'm not an attorney, so please don't take my knowledge as the real, truth. I mean, it is true, but, as come back at me.
Right.
The key thing is that what I'm told is that we could change the LLC structure that owns the multifamily, change the structure closer to the sale, about a month before. Usually we have the sale in 90 days, right? Where the buyer is buying and everything, qualifying for the loan. Loan is approved, due diligence period is gone. Now we are ready that the sale is going to go through. So we break that LLC into smaller TICs, we call it, TIC, tenants in common, and the interest of the investors and the general partner can be put into TICs. And what that does is, as a lender, when they find out about it and they want to see, oh my gosh, what happened? We gave loan to only one guy. How come this whole structure changed into TICs? And as soon as they find that out, the deal closes and they get their money. So they have nowhere to worry about whether they need to worry or not. And then those different TICs can take their portions of the 1031 extras into their own deals. That's what I've been explaining.
Oh, I gotcha. Okay.
Swap and drop, or drop or swap is the term that people use. Yeah.
Right. No, and I think that the reason for that is that in order for the 1031 exchange to be a success, you have to purchase the next property in the exact same entity as the one you're selling.
Exactly.
And so with the TIC, or the tenants in common, you can fractionalize the ownership to where Vinney has his fraction, Darren has his fraction. We can go our separate ways if we don't want to join terms or join.
Exactly. 100% correct. 100%.
So one of the things I just want to ask you about. So let's just stay on the 1031 exchange, not get all wrapped up in the tenants in common here for a second. But the power of leverage. So
Yeah,
if you start with an investment, and let's say that you buy a small property, it's $1 million property, and you're
correct.
able to successfully drive the rents up, and you've contained costs, and you know, let's just say that the cap rates have maintained, but just that appreciation there by increasing your NOI, you've increased the value,
Hmm.
and comparing that against the leverage that you borrowed, right?
Yes,
So you've
yes,
reduced your mortgage has gone down,
correct.
right?
LTV, loan to
LTV.
value,
So now
correct,
your equity has increased,
larger,
right? Right. So now we roll that into the next property, right? And we
correct.
play the game again. We go another 5 years. And so that
Correct.
initial investment started off here, now it's here, and it just, you keep
It just keeps on
exact
going
keep multiplying, right?
higher and higher. Yeah,
Right. And so even if your cash flow, because you started off in a smaller property, was not significant, you can see just by the multiples how quickly it can grow dramatically. But like you were saying, by thinking big, or just, it's the law of big numbers, right?
surely.
The bigger the number, the more the larger the property, the more appreciation on a dollar
Exactly.
amount you're going to experience, just because even if the
So,
percentages stay all the same, if you have $100,000 property versus $1 million property versus a $10 million property, which one's going to have the most appreciation, right?
exactly, the bigger one.
So
That's
right,
so true. Because the cash flow we are affecting rather than 4 units or 10 units, if we are affecting the rents increase in 100 units, the numbers at the bottom will be multiplied. So that's why it's so important that we get on the bandwagon. I say that again, that syndication is the name of the game. I mean, we can have so much money with us, but if we can find a way to learn the syndication game, it is just so scalable very
right,
nicely. And the
right.
best part is we are helping the investors who are great friends. They could be in the circle of friends. They could be in the where we work. They could be our, the CPAs and attorneys. All them. We'll do a big chapter on that one. How to find them. But we are helping them. See, that's what is the main part. Syndication, multifamily investing is helping so many people. First one are the investors. They are busy in making money. They're attorneys, they're lawyers. They want to get piece of the action as an equity investor, not to take care of the toilet, trash, and tenants, right?
Right,
Those
right,
big things. They don't want to get taken care of that. If somebody else can give them 18 to 24% per year, like we have been, averaging in our IRR, 18 to 24 per year, and without their any involvement, just writing a check one time, and they get full transparency. They get all the reports from us and other syndicators. I'm not trying to promote myself, but all those things. That's the name of the game. We are helping the investors. We are helping the residents. That's a huge part. In a bigger scale of 100 units, 200, 500 units, we are helping more families. That's what I want to say, as
right.
compared to one resident in a single family. So there is a big impact in the economy that we are giving. Then we are also managing in our case, but even if property management company manages it, they are employing more people. So we are actually helping more people with multifamily, with getting more vendors, more contractors to do the job and giving a lot of more jobs. And then we are also, like in our case, we have our own 67 employees, 70 now, I think, and they are also getting household run with the impact they are making. And then lastly, I put ourselves at the last, as a company, our family, my family, and kids and all, and we are enjoying the benefits, lifestyle and things. So everybody, it's a win, 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 win,
Yeah,
four
yeah.
times.
You got the trickle down working big time there. You got everybody involved. I love it. I love it.
And
So
then not to mention Uncle Sam federal government, state government. I just found out we had $9 billion surplus in California. Hallelujah.
Oh, really? It's been announced. They'll figure out a
Right,
way to
and
spend it,
it's
I'm
been
sure.
announced, and our governor says he's going to put it for rainy days. It's right. It's okay. I would have loved to get our taxation down a little bit.
Yeah, well, don't hold your breath here. But
I know.
well, Vinny, I think this is a good kind of a place to wrap up. Unless you've got, if there's something that you would like to put a bow on this episode, as far as kind of a reason for multifamily. Is there?
Again, the multifamily is something I would like to kind of wrap it up by the demand.
Mhm.
Our whole chapter, we talked about this interview, what positives are there. I'm sure there are a few more that we didn't discuss, but the big thing is our nation, United States of America, is becoming a renter's nation, more so than 15 years back when I got into it. Now the millennials, our largest percentage of young people from 18 to 34, they are liking portability. They are liking to stay in nice class, B class, A class, or even C plus, communities, multifamily communities that has got a gym, a nice swimming pool, a jacuzzi, a sauna. They do the lawn mowing. They don't want to have a single family home like their parents did. They like portability. They can go from one community in one city to Barcelona for 6 months and then come back and then rent it at another place.
Yeah,
So
how are they gonna teach their kids for an allowance? What are they gonna do, Vinny?
so portability with the millennial and the demand for rentals is so strong, and it's getting bigger and bigger and bigger. And then also baby boomers like me who are retiring, and so retired or retiring, and they are kind of downsizing also. So that's
Yeah.
the other factor is going on in our country. And then immigration also is the third factor. People coming from abroad, they don't have the jobs or the hold or the cash flow to really qualify for loans and things. They also go into the apartments. See, so all those factors really put it big case for everybody to jump into this bandwagon.
No, I love it. That's a great way to wrap this up. And Vinny, before we say goodbye, where can the listeners go to find out more and connect with you?
Oh, sure. Actually, they could text me if they will or call me. I love to give numbers. A lot of people say, Vinny, you're going to return calls. I have team 925-766-3518, 925-766-3518. If I'm in the meeting or my team, they get their text also. If I cannot answer, they will answer, and we will report to everybody. My website is vinneychopra.com. That's www.vinney, Vinney, with a E in there, Vinney Chopra, Chopra. Or you could just Google my name. I think there are 8 pages long now, different videos and my segments and my blogs and everything. They are there.
Got it. And before we say goodbye, I also want to encourage the listeners, if you like this episode, like I said earlier, Vinny and I have committed to doing several more where we get
Yes.
into particular topics about multifamily. So if you have a topic you'd like to hear us discuss, please, by
I
all
would
means,
love. Yes.
send Vinny a message or leave a comment in the show notes
Totally.
and let us know, because we would love to dive into this more and be more granular on various topics regarding multifamily investing. And we'll do another episode here soon. Sound good, Vinny?
Totally, totally, Darren. I definitely want to say multifamily syndication, is the way to go. It. So hopefully next call, I would love to delve the whole hour in syndication world and how exciting it is and how we can power up and how we can get investors and how we can really crush it in a larger scale. Like I mentioned, with the big thinking, it's just extra zeros. That's all my coach told me. He says, Vinny, you can get 10 units or you can get 200 units. It's just the same transaction, just extra zeros.
I love it. I love it. All right. Well, Vinny, thanks again for taking the time. I've learned a bunch, and we'll look forward to doing it again soon.
Thank you, Darren. Thank you so much. God bless you. And what a great service you're providing. That's amazing. I love it. I totally, and thanks. And we'll, try to spread the good word to all your audience and people across the world.
Got it. And for our listeners, if you like the show, share it with someone you know. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.